Rates live with the mortgage calculator. Today we're going to go through some live mortgage rates and we're going to do a deep dive into bank statement loans, very popular non-QM loan here. So we'll go into that here shortly. We'll wait just a few minutes to get started, let everybody go get live on all the different platforms and tune in. We appreciate everybody tuning in nice and early, and we put the chat up on the screen so you can feel free to drop a comment there in the chat as you tune in. You can drop any questions you have as well later as we go through the presentation. Hope everyone's been having a great week. Happy Friday, everyone. Thank you for the comments already coming in there. Owen, Warren, Adam, appreciate it. All right. It looks like we are live on all the different platforms, so we can go ahead and get started. As you tune in, keep dropping comments there in the chat, and also feel free to drop any questions that you have as we go through our deep dive presentation. Welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. And what we do on this show every morning at 11 a.m. Eastern is go through some live mortgage rates, and then we do a deep dive into a different loan topic every day. Now, today's deep dive is going to be bank statement loans, which we're very familiar with here at the Mortgage Calculator. We specialize in non-QM loans, and this is definitely the most popular non-QM loan out there right now. So our sales manager, Jose Gonzalez, with 28 years of experience, is going to do further breakdown of bank statement loans. But before we do that, we'll do what we do every morning, which is go ahead and pull up our pricing tool so we can look at the rates. So Nick, if you're ready, let's go ahead and pull up the pricing and see what the rates are looking like this morning.
All right, thank you, sir. Let me change my screen and we will check it out. All right, this is our pricing tool for our team of mortgage professionals. This will show us the general rates and the APR for today, October 27th. It's just after 11 a.m. Eastern, so all our general programs are live here. So if you'd like a full breakdown of all the fees that go into the APR there, please get with one of our team members. We have over 400 licensed loan officers and can do our primary home loans in 24 states, and our investors we can work with in 44 states for those commercial deals. For the demos, we always choose a scenario that we can compare across the programs. So we'll set the same scenario up, 400,000 loan amount. We'll set the LTV to 80% loan, 20% down payment. We're going to search for the lowest rate possible, especially since rates are crazy right now. And we'll check out conforming conventional first. Then we'll compare FHA, which is usually the second option. Then we'll go into expanded guidelines, also known as non-QM, where we have over 5,000 additional loan programs, such as the topic for today, bank statement loans. We also have VA, which is only for eligible vets and active service members. If you are, just let us know. And we have USDA for our properties that are eligible. If you are shopping for one of those eligible properties, just let us know. Since not everybody is eligible for either of these, we don't do those live. We'll start with conforming conventional. We'll do purchase, 30 years fixed. Primary occupancy, single family home, 1 unit, state of Florida, county of Miami-Dade. And for all the demos, we use an estimated FICO score of 760 and an estimated debt to income ratio of 40. So with these settings, let's check out the conventional options today. It's actually, I think that's a touch lower than it was yesterday, I believe. Just a touch. 7.375, 2.375 discount points puts the final APR 7.587. I believe yesterday it was 7.7 something, so a little bit of relief it looks like there. And we have some great options for our customers that qualify for conventional. But if our customer for any reason doesn't qualify for a conventional program, typically the next option we want to compare with the same exact scenario is an FHA program. FHA does have more leniency for credit issues as well as a much higher debt to income ratio. However, we'll keep everything the same so we can compare apples to apples across the APR. So let's check out FHA this morning, and it looks like a little relief here as well. 6.625 rate, 2.375 discount points in cost, puts the final APR 7.264. So as usual, if a customer qualifies for both conventional and FHA may actually be a touch cheaper, such as in this case. And our customers that must use FHA, definitely a welcome change with the lower MI that has been added this year, which is all included in this APR value. So make sure you use that APR to compare across the programs. Now, where we love to specialize is if our customer doesn't qualify for either program. Unfortunately, many other banks or lenders will deny that customer, but we have over 5,000 additional options. So we'll set up the same scenario here, and this time we'll set to expanded guidelines, also known as non-QM, where we have over 5,000 additional loan programs using alternative income. So we'll keep everything else exactly the same, but we have a new option here for income. So full doc is what we use for conventional and FHA. That's 2 years of tax returns, what most people are used to. So we'll typically choose a non-QM program to take advantage of asset-related, business bank statement. The investor options are just for investment properties. Personal bank statement 12 month, definitely the most popular program, as Kyle mentioned at the start of the episode, and it's going to be Jose's topic for today. As you can see, there's a ton of variation of bank statements, but the personal 12 month is the most popular, so that's what we use for the demo. We also have RSU, stated, VOE, 1099, P&L, no income, CDFI. Please check out some other episodes where we do those examples. For the demo, we always choose 12-month personal bank statement for our self-employed borrowers. Many times, our self-employed borrowers, when they submit 2 years of tax returns, they're most often have issues where they may have various write-offs, may not quite qualify for what they want, or just may need a little bit of extra income to get that home they really want. So we solve that problem with these programs here. No tax returns at all, just their last 12 bank statements to determine a debt-to-income ratio of 40% in our example here, using just their cash in the bank, no tax returns at all. So most of our self-employed borrowers qualify for much more income using this method. So let's check out the bank statement options today. All right. So I don't know why this one keeps showing up. This is full doc, so that's not a bank statement. The first regular bank statement option, this one is a portfolio option as well that may use bank statements, but it's too expensive. So again, because rates are crazy right now, this one is actually the most realistic option here. So we have our first bank statement option with realistic pricing, 8% rate, 2.375 discount points and cost. So this is a reasonable cost here for a final APR of 8.113. So definitely a great option for our customers that need a bank statement option. And we're about 0.5 away from conventional, which is pretty good. Usually we're, the past few years, we were much further away where bank statements was a little bit more expensive. Now we have bank statement options for almost identical price as conventional gets a little bit crazy right now with the market volatility. So definitely some cool options. As you can see here, there's dozens, if not hundreds of variations here for bank statements. Some of these at higher costs and rates may allow bankruptcies, foreclosures, other credit issues, may allow us to use alternative ways to calculate the income. So all kinds of advantages here to using bank statements. Please get with our team. They'll find which one of the hundreds of options will work best. And Jose is obviously going to break down some very detailed variations of this. This is the most basic, but Jose will get into the specifics here. But before we do that, we want to do our final two demos for investment properties. So we love to work with investors, first-time investors, seasoned investors, great options either way. So we'll set up the same scenario, 80% loan, 20% down payment. And we'll look for the lowest option for investment properties, comparing conforming conventional to our expanded guidelines, also known as non-QM. Remember, government programs, FHA, VA, USDA, they do not work for investments. So we'll simply compare these two. Starting with the conforming conventional option, everything will stay the same as our other demos. All we've changed here is the occupancy. So let's check out the investment options. So this is, again, where we have to take it with a grain of salt here. With the way the markets are, this first option that pops up is a portfolio option. So that lets you know it's not actually a true agency conventional product that is backed by Fannie or Freddie. This is an actual custom product that uses the same underwriting as we go through every day. It's conventional underwriting, still uses DU, conventional Oz, However, it does not have the loan level price adjustments that the conventional government-backed programs of Freddie and Fannie have. So you see here the portfolio option with no loan level price adjustments, a much different price, 7.75 rate, 3.25 discount points and costs, final APR of 7.992. And then our first investment property conventional option, pretty reasonable actually, 7.875 for 3.5 discount points and costs. That's a final APR 8.125. So previously they were a little bit further apart with the portfolio option. Now the conventional, since it relaxed a little bit this week, a little closer. But still, if our customers qualify for a conventional option, we can use this cool portfolio one that has no adjustments, same exact underwriting. This one has the adjustments. This one does not. So you can see a little bit of difference in price there just from the low level price adjustments. Now, the other option to find better options with no loan level price adjustments is non-QM. So most investors are going with non-QM right now. So we'll set up the same scenario, but this time we will choose our expanded guidelines, also known as non-QM, where we will have a bunch of options where we won't run into those crazy variations in rates and loan level price adjustments. So the first option we must select is our income option. The most popular for an investment property is going to be our DSCR option because it doesn't require any income or employment documentation from our borrower. Simply use the estimated rental income to determine a DSCR value. It stands for debt service coverage ratio. If the debt service coverage ratio is greater than 1, that means the estimated rents can cover the PITIA of the mortgage payment, aka the property cash flows monthly. If the property doesn't cash flow monthly, that's a ratio of under 1. We still have options for that. For the demo, we always put 1.5, which is the highest value the computer accepts. That way we can see all the programs. And the final thing is prepayment penalty. We always select 3 years. That is standard for a non-QM investment property. There are options for 0 that will limit what shows up and cost more. There are also options for 5 years, which will again limit what shows up, but save our customers some money. In order to show all the programs possible, we're going to select 3 years, which has the most common options. So let's check out our DSCR options today. All right, went down a little bit. That's cool. So best option at the top, still beating conventional, which is absolutely amazing. The true conventional, it's about the same as the portfolio option. But a DSCR option at 7.75 rate for 3.5 discount points and costs puts the final APR there at 7.9, which is again beating the conventional. So I'd say 100% of investors, when presented a DSCR option that beats conventional, will choose the DSCR option, even when DSCR is much more expensive. 90+% of investors will typically choose a DSCR option. For the ease and flexibility, you can start 1, 2, 5, 10 loans at a time. No income documentation, no employment documentation, refi multiple properties, buy multiple properties. Much easier loan here. And if we scroll down, tons of different options here under DSCR. Some of these have a little bit higher costs and rates, may allow bankruptcies, foreclosures, other issues, and also may allow us to calculate the income using different methods, such as the super popular short-term rental calculation. So tons of different options here. Please get with our team to find the best ones. And now we'll get into our example for today. Let me pull back up our slide for bank statement loan. So we always do our live pricing for a general example of a personal 12-month bank statement loan, which is the most popular version. However, we're going to have Jose go into some examples here. So bank statement loans, probably the most popular, I know it is actually, but by data, the most popular non-QM program that there is. There are a ton of variations, though. Remember, in non-QM, every program is different. There's not one set of guidelines for all the programs. Every single program has a slight variation. So hopefully Jose has highlighted some of those differences here and some of the ways we can use these non-QM bank statement programs in order to get our clients to their goal, obviously. But tons of flexibility here with bank statements. You can use them for primary, investment, second home, and definitely the most popular and probably typically one of the best priced options when we go for the non-QM. So these are typically one of the first options that we're going to present our clients once we realize, as we do in the demo, that conventional full doc doesn't work, FHA full doc doesn't work. This is typically the next option we want to go to for most customers that are self-employed where full documentation isn't quite working, because we're going to go into a whole new set of qualifications. Most importantly, a whole new way to calculate income, which, as I say on the demo every day, most of our self-employed borrowers will qualify for much more income using these methods, sometimes double, maybe even more. So a lot of flexibility here. Remember, self-employed only, can be used for any type, and it's the most popular. It's not the only, but it is the most popular. So hopefully that's a good intro for you there, Jose, but go ahead and take over if you're ready.
Good morning, everybody. Thank you for joining us for Daily Race Live with the Mortgage Calculator. Great to be with you this morning, especially with one of my favorite loan types, bank statements. It's great to blow people's minds when you can tell them that they qualify for that $2 million or $3 million home just using their bank statements because their tax returns may be showing a loss, right? Tax returns showing a loss. They don't qualify for anything. They go to Wells Fargo. They say, sorry. They come to Mortgage Calculator. They say, you qualify for a $2 million home. They're like, oh, where do I sign? It's awesome also because you do not have to, it is for self-employed borrowers, but you do not have to be incorporated. You do not have to have an LLC. There's many different ways to be self-employed. And usually we have options with just that self-employment can be verified by simply a letter from your tax preparer verifying that you've been self-employed for at least the last 2 years. That's all it takes. Some people misunderstand and think that it's LLCs only or a formal business only, but you can be self-employed and be a handyman and be a sole proprietor, and as long as you have some type of verification that you're self-employed, and the best and easiest is a letter from your tax preparer. Now, earlier this week we spoke about the 1099 program, which was an option for our self-employed borrowers who receive a 1099. That's usually going to be a better option because we can usually get a higher profit margin or lower expense ratio, depending if you consider the cup half full or half empty. It's the same thing. With 1099s, you can go up to 90% without a problem. Bank statements is a different story. Bank statements, the default is usually 50% without any additional documentation. And then if you can provide a letter from your tax preparer, a business narrative letter where the tax preparer touches base on what the business's expense ratio is. So, for example, tax preparer, after reviewing financial states that the expense ratio is 30%, means that we will be able to use 70% of the applicable deposits. Remember, they have to be business income related deposits only. So you do have to review the guidelines because they all vary on how they review that. The other thing to know when seeing which conduit you're going to use for your loan is the business type, right? Because some guidelines do really focus on the business type and then set different expense ratios. So it's no longer just a default 50%. They're going to say if your business is type A, it's going to be a 70% expense ratio if they view it as a lower margin, higher overhead business. And conversely, someone, for example, who works out of their house as a financial planner, doesn't have an office for overhead, doesn't have staff, that person, that borrower would probably be able to get a 70 or 80% profit, or let's say 20 or 30% expense ratio, because it makes sense. So just keep an eye out on that, because as you all know, not all guidelines are created equal. That's why we love being consultants at the Mortgage Calculator, so we can review all the applicable options and help guide the customer towards the one that best meets their objective. So let me share some examples with you today. I decided today to break it up a little bit because since bank statements is such a popular option, I want to show the rates at different LTVs, because in the non-QM world, LTV will affect your interest rate much more than in the agency world. So non-QM, definitely got to pay attention to the LTV and provide the borrowers multiple options. So the highest LTV possible in non-QM is 90%. Same for our bank statement option here, 90%, but no mortgage insurance ever applicable uh, at 80.01 or above, as is the case in agency. So you got to remember, as I was saying, LTV does affect rate, and one of the reasons is because they're going to build in the MI, quote unquote. There is no MI, but it's just the risk. The additional risk is quantified by higher interest rate. So in this case here, primary primary one unit, 90% LTV. Our lowest cost option is 10.875%. And you can buy that down to 9.625%. And I'm going to add another caveat here. You always notice that we will limit usually somewhere around 2.5%, 3%, depending on the loan amount, sometimes a little higher, in terms of the buy down that you can do. However, that does not mean that you cannot buy it down lower. What this simply means is to remain in compliance with the laws. There's certain limits that we have to stay below. However, if you are able to negotiate some seller contribution, then the seller contribution can be applied towards the points that are associated with the rate, and then any seller paid loan discount does not get counted towards the points and fees test. So in some markets, I am seeing seller contribution now. So keep in mind, if your borrower is especially rate sensitive, seller contribution is the key to try to buy it down some more and have your file stay within compliance. So here, if our seller was paying 1% of the sales price towards our closing, we could probably be somewhere in the low nines would probably be possible, or maybe even the high eights for this borrower. But here we're assuming no seller contribution. But I just wanted to throw that out there so that you all know that there are rates below the ones we post here. They're just not going to be compliant unless you get seller contribution to pay. So now, like I mentioned, I was breaking it down. I want to show you the difference in the LTVs, how they affect the rate. So here, 85% LTV, the same, one unit primary, but now you see considerable drop. 10.5% is only costing a quarter point, whereas over here, 10.5, 10.49, 10.5, same thing, is costing 1.375. So there's about a 1.125 point swing to go to 85. And then obviously you can also buy it down to a lower rate. So there's going to be multiple benefits there for the borrower. So in this case, as you see, 10.5 lowest cost option, 9.75 lowest rate option. Then 80%, you really see a difference, right? Because now 80% is more standard. There's more options, less risk. Remember, risk is directly proportional relationship to rate. The higher the risk, the higher the rate. And lower the risk, lower the rate. 80% LTV is lower risk. So 8.99% is almost at par. And you can buy that down to 8.125. But I did see, for example, when I was seeing my rate sheet, 7.99 was costing 2.625 and 7.875 was costing 3. So again, there are options there if you get some seller credit. And now I wanted to show, this is a big loan here. I wanted to show everybody out there that we do some nice loan amounts. Now, this is not our maximum loan amount for this program. I just wanted to throw it out there because I actually do have somebody shopping for something like this. He could be watching the show, and I wanted to let him know where we are today because he's buying a new construction and it's not going to be ready for a couple of more months. So we were looking at 8.625. Here is actually giving you a little bit of a lender credit, Here we're looking at 7.75, but I'm going to tell you what, on a $1.9 million loan, you're not going to have any problem. The system just didn't let me pick it, but you're not going to have any problem going to 3% or 3.5% in loan cost and still be in compliance, because it's 5% is the max there. So again, 8.625 is at par, 7.75 is our lowest cost option there on our rate sheet. And then our 2 to 4 unit purchases for our house hackers out there.
Is this? We have a question, Jose. Let me bring this up since you're literally doing it. So, Leonardo's question is, what's the maximum LTV for a multi-unit?
You're looking at it right here. Yeah, so, great timing, Leo. Yeah. Great timing, and I will let you know the
that is the max, though, correct? Yes. That 90 that you're showing. Okay.
Yeah, and not only, that's a max for a 1 unit. But the great news is that there are not that many options, but we do have options for up to a 4 unit at 90%. Most of the other conduits out there reduce the LTV by anywhere from 5 to 10% for that multi-unit, but we do have still 90% for a primary. Now, I will say the rate is a little bit lower in the bank statement option than the 1099 option that I remember the other day was a little bit higher than 11% for the lowest cost option on the 1099. It's because bank statement, they're looking at money coming into the account. Maybe they see that less risk, and you also in the bank statement loan, definitely less risk because they're considering less of the income. Remember, 1099, they're going 90%. Bank statement, they default usually to 50%. So much safer hedge for the investor lending the money. So here, 11% is almost at par, and you can buy this down to 10.125. And again, primary 2 to 4 unit, 90%. So now let's go with some investment properties here. 1 unit, 85% is the max on a purchase for investment. There are no 90% options out there, and 85% is actually the outlier. Most are really at 80%. So you do see here 10.499, lowest cost option, buying it down to 9.625, lowest rate option. And now our investment 2 to 4 unit, hold on. What did we have here? Oh, yes. Okay. 2 to 4 unit. We can still, again, great news, still go to the maximum LTV of 85% on the investment 2 to 4 unit. So, Leonardo, depending on if your borrower is a primary home house hacker or an investment property house hacker, still good options here at 10.499. The rates are very similar, just the LTV drops by 5% is what you are looking here for this option. 9.499 lowest rate option. And now we got some cash outs. Our 1 unit primary max 85%. So as is the usual, there is a 5% LTV drop when we're going from the purchase or rate and term, because purchase and rate and term usually going to be the same. When we go from the purchase or rate and term to the cash out, here 10.75 is almost at par.
Can you highlight the max LTV for conventional in this case?
Oh, well, okay. 1 unit cash out primary, I believe that's 80%.
Yeah.
And that's full doc.
Exactly.
And you'd be hard pressed to get some compliant rates too.
So these non-QM programs can actually exceed the LTV of conventional in this case, which is amazing.
Yeah.
And no MI.
Yep. No MI either, which is a beautiful thing. So that's why our investors love it. So here, 10.75 is almost at par, and you can lowest rate option here, 10%. And let's got 3 more for you. Our 2 to 4 unit primary. Again, great news, Leonardo. Your borrower can cash out refi up to 85% LTV on a 2 to 4 unit. Now, going back to Nick's question again, on a cash out on a 4 unit, I can't recall right now the matrix for agency, but it's somewhere around 70 or 75% for a 4 unit, I believe. I don't know if it's 70, maybe. I can't recall right now, but it's something around there. And it's going to be really high cost, may not even be in compliance unless your borrower has like an 800 credit score. And here we're looking at 10.5, almost at par, 9.75, costing you 2.25 points. So this especially.
That's a primary. Yeah, primary is 75 on a 4 unit.
75 on a 4
Investment
unit.
max conventional
Here we
is
go.
70.
And
so
here we're at 80.
Non-QM can exceed the cash out LTV of agency by 10% on those multi-units. Big difference there, guys.
Look at that. Investment property, 4 unit, cash out refi, 80%. Oh, I mean, we're already forgetting, though, this is bank statement on top of that. I mean, this is now full doc, which I do want to remind everybody when you are pricing out your scenarios, structuring your deals, keep in mind that usually a non-QM full doc, traditional quote unquote full doc, and a bank statement loan. Let's assume same scenario, right? Primary and all that kind of stuff. Side by side, apples to apples. Usually the pricing is going to be the same, or at most you may have like a 1/4 point difference in the cost to the same rate. So keep that in mind when you're looking at a self-employed borrower who has super complicated tax returns. May just be worth it to go bank statement. So here, our 80% investment 2 to 4 unit cash out, which is the max LTV for a 2 to 4 unit cash out. You're looking at 11.624, almost at par. And you can buy that down to 9.249. Pretty amazing there. And our bank statement 1 unit cash out, 80% LTV. You're looking at 11.624 again. And buy that down to 9.249. So a lot of bank statement options out there, a lot of bank statement loans out there as well. Number one non-QM loan origination, and you all can see why consumers have really embraced the bank statement loans, and we definitely have a lot of self-employed people. I think also a lot of people went self-employed during and after the pandemic, and so we're just getting whole fresh batches of newly minted 2-year self-employed borrowers looking to cash in on their self-employment status.
Great point. All right. The only question we had was already actually answered there. So I think we are good to go. Remember, we do this show 11 a.m. Eastern every single weekday morning where we go through the live rates and then do a deep dive into a different topic. Today's topic was great, very popular loan product. Tomorrow will be, or not tomorrow, excuse me, Monday we'll be back with a brand new topic. So thank you everybody for tuning in. Thank you, Nick. Thank you, Jose. We'll see you all on Monday, 11 a.m. Eastern for the next episode of Daily Rates Live.
We have one question.
Very good question too. Do they have options for 1 year self-employed? Yes, but there are catches. Right now, I just saw something come across my email the other day on this. Usually, what it's going to boil down to is, now this is in the majority of the cases for this option, right? Is if they're in the same type of industry, same type of job. For example, you had an electrician, right, that was working for a company as an electrician, and now they've been 1 full year at least self-employed as an electrician. That one would be considered. Now, I did see something the other day from a broker outlet that I haven't reached out to where it sounded like it was a true 1 year self-employed option. I'm going to look into that. Probably going to be low LTV and high rate, but in the majority of the cases, what we do know is that if they're in the same industry, you can do it 1 year, you just have to provide documentation of what they were doing. Sometimes maybe they had a business, maybe they had a license, some type of certification for what they were doing, and now they're doing it self-employed. Like I have one that the borrower is working as like a nurse practitioner um, for like 20 years, and now for the last year she's self-employed as a nurse practitioner, right? So that's a perfect one there to go bank statement.
Looks like we have some more questions coming in.
Chris is making a statement that they must have 2-year overall. For a more common exception, yes, but there are some programs that advertise a true 1 year. But the more common that Jose explained is 2 years overall. Will definitely put the story together and work for most, not all, most bank statement options, right, Jose?
Yeah, you do have to scour the guidelines because some are more conservative than others, and that's usually expressed in more favorable pricing. Remember, they tweak their guidelines to hedge against risk. They can offer better pricing because they're going to be able to sell their packages for more money, right? Which means a lower yield to the investor that's buying the package, which means a lower interest rate to the consumer.
All right, this is a good question. You didn't go over, but what is the standard DTI that you use for all of those? Because there are variations, but what are the standards? I guess
Standard is 50%, but like always in the non-QM world, there are exceptions because all guidelines are not created equal. So we actually do have options up to 55%, but there's going to be requirements to be able to go there, usually having to do with FICO score, other factors like that. But there are 55% DTI options.
and it will usually reduce the LTV if you need to use a higher DTI, correct?
Yes.
All right, good questions. Those are good
And
questions.
we do go with DTI to qualify. I guess to directly answer the question, DTI is what is used to qualify the borrowers. Like every other loan where income is being reviewed, the loan types where DTI is not used are the DSCR program, which is just a different DTI calculation per se, right? It's the debt service coverage, which is gross rent generated by the property, gross monthly rent divided by the housing expense, PITI, and if applicable, association fee is your debt service coverage ratio.
All right, great. Glad we had some more questions today than usual. So good questions there. All right, everybody. Well, we will see you all in the next episode of Daily Rates Live with the Mortgage Calculator on Monday, 11 a.m. Eastern Time. Everybody have a great weekend. Take care.
Thanks, everybody.